Good morning, everybody. Welcome to this Monday morning game plan, 9 a.m. You guys are right here with me, and that is awesome because we're going to go over a lot of stuff today, folks. I had the weekend to look at macro data and just really filter through all the nuts and kind of craziness out there. Now, again, just a reminder, the game plan, which is what this is right now, is for people that want to be prepared for the coming day, the coming week, and the coming month. All right, now again, we're going to cover day trading stuff, we're going to cover swing trade ideas, we're going to cover macro, we're going to cover it all. And the idea is, folks, this is where you get the other side. All right, now if you want to turn on CNBC or Fox Business or anything else, feel free. But I'm going to show you stuff that they won't show you, and I'm going to let you know things that they won't let you know, because I think we as a population need to be fully informed. All right, so game plan every day this week at 9 a.m. Make sure you join me. First thing, we're going to look at some macro data. All right, take a look at this chart over here, folks. Let's talk some real numbers here. All right, so this is, as it says, the U.S. government annual interest expense. All right, look at what has gone on here. Interest expense is nearing $1 trillion a year. All right, that is now greater than the biggest part of the U.S. budget, which was the military expenditures, right? So again, the U.S. spends, I think, $800-something billion, which, by the way, is like more money than the other 5 top countries combined. That includes China and India and lots of other big names out there. So not only is the U.S. spending a ton of money on military, which you could argue is a good thing, but also look at what's going on here. The interest expense. Now, I look at interest. When I'm paying interest on something, it's money that's going in the toilet. It is money that's getting thrown away because, again, it's just getting paid out because you spent too much damn money and now you have to say, okay, well, we have to pay that back or we have to pay the interest on that. And again, the problem is this, folks, is that I've been arguing that while we have an economy that right now is still growing a little bit, GDP is still growing a little bit, I've been saying that there's dark clouds on the horizon. And when you take this much money and you flush it down the toilet, when this money could be going to growing the economy, when it could be going to, let's say, healthcare or Social Security or other things, that to me is horrendous. And every American, every person out there, and by the way, it's not just America. Go to any other country out there and you're going to see a lot of the same stuff. And that is a problem. All right. Next, on to the macro front, guys. I got to show you this here. So again, next I want to show you this. Now, this is average monthly payments for new cars. Now, again, for those of you that may be in your 40s or 30s, when you first got a car, I remember I had a little Honda, I think it was a Honda Civic. I think I paid $200-300 a month for that lease. Look at what's happened, guys. All right. Look at the average monthly cost. And the reason I'm bringing this to your attention, I'm showing you costs that are advancing, costs that are blowing up. And because ultimately this sucks more and more money out of the individual, the consumer, that is going to be harder and harder to kind of keep the economy trudging along, especially when you have interest rates going nuts. So again, you're now talking about the average American, the average person is now getting close to $750 per month on a car payment. All right, on to the next one we go here. Now, this is a pretty crazy one, folks. Now, we talk about how the economy is offsides. And this is showing us, and I apologize, it didn't come up here. Not sure really why, but in any case, let me try this. Nope, it's not going to want to come up. Okay, in any case, that's okay. What I'm going to tell you is this, exactly this. All right, so what we have here, folks, is the chart showing net speculative positions in treasuries has collapsed. Now, what's amazing about this is that we have net speculation in treasuries, meaning that people are more interested in being in stocks than pretty much any time else in history. Now, think about what that means. You have U.S. bonds paying more money than they have. Interest rates are as high as they have been in 22 years, meaning that even when interest rates were, 25, 50 basis points, people were more interested in being in bonds than they are now. All right, meaning that people are more interested in investing in stocks right now, even with the bond market paying what it is. That is a huge lopsided issue, folks. And again, think about this. Think about it logically. Like, Does it make sense that when you can get 5%, let's say on a treasury, that you would be still more interested than you were when you could make 0.25% on a treasury or half a point on a treasury? You would still be more interested in investing in stocks? That is a way offside scenario. All right, a couple other things here I just want to show you guys. I want to tell you why GDP is a fake number, or why we're seeing GDP. So right now we know GDP last week came in higher than expected. And the kicker is this. This is what most people don't know. When real imports, when imports drop, all right, so meaning that when you as a group are importing less, so the American public is importing less from China, from all the other countries, GDP actually naturally will go up because imports are subtracted from what's going on in the US. So, for instance, when you have GDP at 2%, well, let's use a bigger number. Let's say 5% GDP, or it would be 5% GDP, but you're importing 2%, then your actual GDP is 3%. You're subtracting what you're importing. Now, the problem with your GDP numbers is that we have now seen a decline, a massive decline in imports in the US, which is artificially buoying the GDP number to the upside. So again, everyone's so amazed, like, oh my goodness, 2.4% GDP. Well, yeah, but why are we're seeing imports decline precipitously? Now, you might say, oh, this is great. Maybe the US manufacturing side is doing so much better. This is the kicker. Is it that, or is the economy weakening, and are we importing less because the consumer is weakening? And even if the consumer is weakening, which by the way shows you that a recession is probably 3, 6, 9 months away, even that, a consumer weakening in the short term artificially lifts GDP. So these are things, again, folks, that even I didn't know a few years ago. But as we get into this data and you dive in and you do a deep dive, you start to recognize more and more. All right, enough of that. I want to go over here, guys. We're going to take a look at SOFI. All right, so SOFI's chart, we can see here it is gapping up. They had earnings this morning. All right, we're going to go to the daily chart. Now, this is kind of a AI play, and therefore it's obviously going to have some action. The only level I see for a day trade or even a swing trade, and mind you, this is for swing trading as well, is that you have this level right here. So right now we're trading at $10.53. If for some reason we get to $13.50 today, let's say it squeezes, let's say it's a short squeeze, you're going to be looking at major resistance at $13.50. The kicker here is this, is that basically as a trader, you can day trade that level, you can even swing trade that level. And let's not kid ourselves, right? So if we look back, SOFI was trading at $4. So going to $13 to $14 is a multiple 100% move from those lows. By the way, good bullish consolidation here, so not surprising it's going to get a little bit of a lift off. I would not short it personally until at least that $13.50, $13.75 level. But once it gets into that level, it does become an interesting short. Now, there is a level on Adobe, guys. Adobe is up a little bit today. It's had a pretty big run here, and I want to zoom in on this because, again, I think this is a good level here. So Adobe, you're going to have a lot of resistance. So we can see Adobe's had this big move from about $320 all the way to $500. Today it's trading at $544, which is up about $16 on the day. There's a level, there's a pivot right here, okay, right there. There's a gap fill right below that, and that's at $559. So $559 is going to be resistance on Adobe today for a potential pullback in the chart. All right, now I want to continue on here, all right? So I want to go over some various thought processes. Now, one of the things that I've said recently, folks, is that AMD, if you want an interesting pairs trade, now pairs trade is kind of a hedge trade, and a pairs trade would be where you go long something, but you short something else. And what I've been showing people here is that there's this opportunity in my book for AMD to play catch up to NVIDIA while NVIDIA reverts back to the mean a little bit, right? So if we look at the charts, in fact, I'm going to go to the chart of NVIDIA, and this is a fascinating, by the way, this only works as a pair trade. Someone before was like, oh, I just went long AMD. I'm like, dude, like that is not what you're supposed to be doing. A pairs trade, you have to do both. You go long AMD, you short NVIDIA. So if we go here and we just add the AMD chart right into this chart here, what we can see, okay, what we can see is that in general, over history, right, if I zoom out here, look at this. They track each other almost identically, Okay. However, starting in 2023, they diverged. You had AMD just going up a little bit while NVIDIA has soared. So the concept here is a very simple one. If they just start tracking each other again and you're short one and long the other, you don't lose anything. It's a pairs trade. One goes up, the other goes up, one goes down 1%, the other goes down. My thought is this, and this is the kicker, is that this is beaten down, and they're both in AI. I mean, and AMD is going to be nipping at the heels of NVIDIA, is that you'll see AMD rally a little bit more while NVIDIA comes a little bit in, and that's the perfect scenario. Now, you could get a non-perfect scenario where AMD goes up more than NVIDIA, and maybe NVIDIA goes up 10%, AMD goes up 20%, you make a little bit of money. The best case in this scenario is to see is NVIDIA retraces a little bit because it's overbought, AMD, which is kind of consolidating, goes up a little bit, and you make it on both sides of the trade. So you make the short money on NVIDIA, and you make the long money on AMD. And again, it's an interesting trade. Doesn't mean there's no risk. I'm just pointing out different thought processes or different ideas for you guys as investors to think about. My goal here is to have you guys thinking outside of the box. I want you guys thinking about things that normally you're not going to hear anywhere else. And again, that's where I come in. All right, so let's get right into it, folks. Let's look at different tops in the market. Now, this is going to get into something interesting. So one of the things that we have, as I'm getting rid of this chart, we have the S&P 500. In fact, let's go to the SPX here. All right, so the SPX, we can clearly see here, is slowly moving back to all-time highs. Now, you have two types of tops in the market, and this is the thing. Either one could occur. Now, I'm in the favor of us not taking out the S&P high nor the NASDAQ high. I could be wrong. But you have two types of tops. So what are the tops? One is a top that we saw in 2007. So if we go to your weekly top chart and we go back to 2007, okay? All right, so here's what you would refer to as an M top, right? That's your top right there leading into the Great Recession. Now, you might recognize this chart pattern, right? So this chart pattern is very similar to what we saw on, you can guess it, Bitcoin. All right, so if we look at Bitcoin, if I can type it in correctly here, there's your M top on Bitcoin. So what we see here is that the two types of tops are as follows. So you have the M top where you make a slightly higher high. Now, why do all of these make a slightly higher high? They make a slightly higher high because you have to lure in the last people on the sidelines. And if you don't take out the previous top, like here you took out the top, which made everyone thinking, oh, it's going to be a double top, they got lured in right here and they covered their shorts and they went long. This is a classic pattern. The market wants to make you flip the lid, essentially, and then it tops out and pulls the rug. And so that's exactly what we saw in 07. The other scenario could be something like you saw on the Dow Jones Industrial Average in the different points here of, let's say, the Great Depression, right? So if we go all the way back here, and I'm just going back decades and decades here, but if we go back to the period here, this is your other type of top. All right, so your other type of top is you have the down move, you then have the retrace, which is significant. In this case, you fell 51%, you retraced 40, basically 50-50, right? You fell 50, you retraced 50, and then you had the big decline. Now, right now, if we go back to the NASDAQ or the S&P 500, if we look at that, we're still in that first one. We're still here. We're not at the highs. So here's your pivot high down. Here's your retrace. So the question is, are we going to continue and take out this high by a fraction before that rollover occurs, or are we going to roll over first? Okay? All right, so just a couple little tidbits there I wanted to show you guys real quick. Couple other things on the charts that I want to go over here real quick as well. Let's go into the crypto markets and see what the crypto markets have in store for us. Now, this is a kicker, guys. I showed you guys this last week when it was early on in the bear flag. This now is a mature bear flag. In addition, you have a time count. Time counts are powerful signals. They're timing factors that repeat over and over. In fact, if you go into the time count that I use is the 7 factor. And you could go through any religious text. You can go through almost anything, 7 days in a week, the 7 deadly sins. You could go, there's things that in human nature repeat over and over again, and they repeat in charts over and over again. So just to give you a sense of this, right? So you could look here, right? Pivot low, 1, 2, 3, 4, 5, 6, 7. All right, here, 1, 2, 3, 4, 5, 6, 7. So the idea is that nothing's written in stone. It doesn't mean it's a guarantee, but what it does mean is that in general, bigger moves or significant periods tend to occur on a 7 point. All right, and this is stuff, by the way, if you want to get more interested in this and you want to learn more and more of all this knowledge base, the Winning Trader series at verifiedinvesting.com is where it's at. That's where literally it's 20 hours, 3 courses, 20 hours. I tell you my secrets, every little tactic I've ever come up with. I basically brain dump all my knowledge into that. You guys can find it at verifiedinvesting.com. All right, so this is bearish. The idea is you likely are going to have a down move. I think your max downside right now remains at 27,000-ish, give or take. It's an upsloping trend line. Nothing really has changed from last week on that chart. Now, I am keeping an eye on Matic. I think Matic is starting to break lower here. All right, we've broken below this flat line right here. That's problematic for Matic. But again, we're looking at another support probably in the 65-cent range. All right, so there are opportunities here. And let's just go over ETH real quick. Then we're going to flip into some commodities out there as well. We also should look at the US dollar as well. And by the way, I didn't even mention this. In fact, let me talk to this screen right here. I didn't even mention this yet, but last night, Japan came out with a bond buying program. Now, what's nuts about this, guys, is that just last Friday, on Friday, they came out and were like, hey, we're going to let our yield curve control loosen a little bit, which means they were, basically they're letting yields float. When a central bank buys bonds, they're doing the exact opposite of that. And so this was almost shocking because to go from one extreme to the other, you know what that tells you? That tells you that the central banks inevitably will always go back to printing of money. And while the US isn't at that point yet, it is going to be at that point at some point, whether it's a year from now, 2 years from now, or who knows when. But it will get to that point. All right, so again, doesn't mean, by the way, doesn't mean their yield curve. I think what ended up happening, to be honest, just to be flat out with you guys, is my guess yields started to jerk up too much, and so they didn't want too big of a move initially, so they kind of had to do some bond buying to bring that back into check. But I do think that they are trying to loosen it because inflation is everywhere, folks. I've showed it to you. And by the way, let's go back to this chart here. And again, sorry to get off of Ethereum. We'll go right back to it. But would you look at this? This is oil just today, folks. This is oil from the beginning of July. All right, so yeah, you want to tell me inflation's not around anymore and it's going back to sub 2%? Okay, let's be real. All right, gasoline, you want to see what gasoline's doing today? We'll go back to Ethereum real quick. I don't mind. That's your gasoline for the month of July. So you're looking at month-over-month numbers spiking. Okay, this is inflation is going to be stuck at 3%, give or take. Doesn't mean it can't go to 2.9, 2.8, whatever. But I'm going to tell you right now, it's not going sub 2%. I've said this for 6, 12 months. It's going to get sticky here. 9 to 3, that's like me getting in shape. You know what the hardest thing for me to do when I get in shape is? Get a six-pack. That's the equivalent of going from 3 to 2, to finally get that little six-pack. Hard for me to do personally, just the nature of it. But again, it is what it is. All right, last thing, let's go to Ethereum. In fact, we'll go over the metals charts quickly as well because I do think the metals are important. Ethereum here, folks, bearish consolidation. You've been in a general downtrend. This is your down target, 1750. I would continue to expect 1750. And by the way, doesn't mean we can't go higher. And like I said, with the Fed going back eventually to printing of money with what we see in Japan, eventually we're going to see Bitcoin and Ethereum rocket. All right, eventually these things are going to go. Is the 4-year cycle in stone? I think people that are adamant that, oh, it's a 4-year cycle, they're new investors. That's just the nature of it. You know, when you trade a market for 20 plus years, and I had about 10 years prior of trading experience before Bitcoin was even invented, you start to realize that cycles, the trust in cycles needs to be a lot longer than essentially 14 years, right? And so You have 4-year cycles when the Fed is printing money, and then you have question mark when the Fed's not. And that's what we're in right now. And that's why, honestly, I don't trust the 4-year cycle right now, because yeah, you have the halving next year, which may be good, but everyone's banking on it, which makes me right away skeptical. And that's always something to remember, folks. When everyone else is saying something, it usually doesn't happen. But also just remember, if the Fed is not printing money, at least in this point, the cycle could be elongated. The bear cycle could be elongated. All right. Again, that's Ethereum. Let's go to gold and silver real quick here. Let's see what gold and silver have in store. Gold is upticking just a little bit. I continue with my overall very bullish view on gold. Doesn't mean it can't have a little bit of a pullback. Here's your triple top right up here, guys. Triple top, pivot, pivot. Just a reminder, triple tops, you get small pullbacks than breakouts, generally, right? Probability-wise. Here's a pivot high. Here's your double top, big pullbacks off double top. Here's your triple top, small pullbacks, then breakouts on triple top. Now, again, is this the sexiest asset? No. But it is an asset that probably gives you a certain sense of safety. Like, could gold go down 10%? Yes. But I would argue that the stock market could go down 20 to 30 to 40%. Can Bitcoin go down 50% back to 15,000? I think so. And again, I think people, you have to understand that it's not about how much you can make in a trade. It's about how much you can protect yourself on the downside if you are incorrect. And I think that's what it comes down to. All right, so that just brings us full circle here, guys, as we get back to things here. So I want you guys to be clear. This week, to summarize, the big things this week, you have Apple and Amazon earnings Thursday after the bell. Friday, we have the non-farm payrolls number. All right, that's the major keys for the week thus far. We have some economic news throughout the course of the week. I will be updating you guys every morning at 9 a.m. Eastern Time. I'm going to bring nuggets of education, things that you may not even know. I am going to be here guiding you, holding your hand through different moves in the markets, through crypto, through stocks, through commodities, through macro data, and I will give you the honest truth about what the heck is going on out there. And I think we all know that. As good as GDP sounds, I think that there's a lot of Americans out there that are struggling. And by the way, there's a chart, and I'll try to show it tomorrow. There's a chart that shows the divergence between basically the people that are wealthier. The consumer confidence for the wealthy is shooting up. The consumer confidence for the the middle to lower income is collapsing. Now you might say, well, wait a minute. All we heard was that consumer confidence was great. Well, yeah. When you average in the wealthy, it is. Well, why the heck is the wealthy consumer confidence doing so well? Could it have anything to do with the stock market? So again, the stock market is a key component here. As long as the stock market stays good, then the economy probably does well. But as soon as that stock market gives way, be very careful, folks. All right, my name is Gareth Soloway. Follow me on Twitter. Follow me on YouTube. You guys, I will be back 9 a.m. tomorrow to break down more data. You guys have a great one. This is the game plan. And again, my name is Gareth Soloway. Take care.